Okay, so I was saying regarding Matrix Zedu, we have to separate. We have the sales tax and the tax, the corporate tax. Those two types of matrixes, they're actually different. So Kanachasa matrix, it can be we have the sales tax or we have the corporate tax. So there are other different forms of taxes that we also have. So in this case, it's not sales tax that you're dealing with, but the type of tax you're dealing with is corporate tax. So let's be able to differentiate first these different types of taxes. So the first, we have sales tax. So the sales tax or VAT tax. Sales tax, this is a type of tax which is charged on the sale of taxable supplies. So if we are to sell VAT taxable supplies, you are supposed to charge VAT tax to your customers. So the VAT tax is charged by the company to the customers, but this type of tax, it belongs to the ZIMRA or to the government or to the regulatory authorities. It is not tax for the company. So you are charging the tax to your customers. It's just passing through you, but going to ZIMRA. So you are just a middleman for collection of the tax, then you pass it to ZIMRA. So one key characteristic or two key characteristics that you need to take note of. If it sales tax, it's not paid by the company, not borne by the company. By the company. So if it sells tax, this one is not suffered by the company. This is actually tax which is borne to the consumers. It is the consumers that are supposed to pay sales tax, but it is collected on behalf of the revenue authorities. It is collected by the company. Then also, when we are recording our transactions, we don't include sales tax because it's not our tax. So we record transactions net of sales tax. So we don't include sales tax. We don't include sales tax in the sales of the company. So we record our sales exclusive of sales tax. We don't include sales tax when we are recording our sales. Then let's move on. The other type of tax, we have corporate tax. So corporate tax, this is tax which is paid by the company. If it's now corporate tax, it is the company that is supposed to pay for the corporate tax. It is the company that is supposed to pay the corporate tax. So the company pays the corporate tax to the revenue authorities. It pays the corporate tax to the revenue authorities. So it is charged on the company's profits. If we are looking at the corporate tax, this is charged on the company's profits. So if we make a profit, we pay the tax. If we make a loss, we don't. So it is charged to the company. That's the difference. It is suffered by the company. So in the company's books, this one is recorded, and it is recorded as an expense to the business. So this is charged on the profits of the company. This is charged on the profits of the company. This is charged on the profits. So we don't include the sales tax as an expense, but the corporate tax. Then besides that, we need to know about the T account for the corporate tax. I think for sales tax, we did, there was a question on that, and we did look at that. Now let's look at the T account for sales tax, the corporate tax. So let's record the corporate tax. So for corporate tax, it's normally paid as a liability. So tax for this year, we are going to pay it next year. So we start with the balance BD on the credit being the amount of tax you calculated for this year, which you did not pay, which you are likely to pay next year. So the balance for tax for this year, that's, or you can say the balance for tax for last year, which was not paid, that is the balance BD. It can be the owing BD. Then the tax that you're going to pay for that year, tax paid, the tax that you're going to pay in that year, that's what you debit. Then we have the tax for that particular year, you record it as profit and loss. So the tax for this particular year, we are talking about the tax we have calculated that we are supposed to pay for this year. The BD is the tax for last year you are supposed to have paid. So the profit and loss is the tax computation for this year. Then the balance CD is the amount you are owing at the end of the year. So now let's go and fill in the amounts for that. Let's go and fill in the amounts for that. So we have the balance BD. So our balance BD in this particular case is the tax we are owing from last year. Let's go to our question. So how much is it that you're owing from last year? That's 130,000. And the amount we are recording in the profit and loss, it's 145,000. So we have 130,000, 130,000. Then for the profit and loss, how much? 145,000. Then how much are we owing at the end of the year? How much is the amount of tax being owed at the end of the year? Oh, sorry. In this particular case, they've said what? What is the question? I misread the question there. And so what is the cash outflow for income tax for inclusion in the statement of cash flow? So yes, what they want is the tax paid. So the amount that we take to the cash flow statement is the tax paid. So we are looking for this amount here. So they should give us the closing balance. So it means we'll be given the amount at the end of the year, the balance at the end of the year. So how much is the balance at the end of the year? 140,000 years. So it means that's our balance city, that's 140,000. So 140,000. Then from there, we close the account. Then close the account. So the tax paid becomes the balancing figure. The tax paid becomes the balancing figure. So this is what we take to the profit and loss as the amount of tax expense. So that's what we take to the cash flow statement as the tax expense. So the 135,000, this is what we put under operating activities, cash flow from operating activities, where we deduct the tax paid and the interest paid. So the account is the same for calculating the tax paid and also for calculating the interest paid. So in terms of the layout, the account is the same. Now let's move on to the next question. So the next question was then saying, after that, the next question is saying, Alex uses the FIFO, first in, first out method of inventory valuation at 1 August 20x5, at 1 August 20x5, Alex had 48 units in inventory at a total value of 450. At a total value of 540. The following inventory purchases were made in August. So what is the value of inventory? So what is the value of inventory on 31 August 20x5? So the value of inventory there, so for the value of inventory, we are told they are using FIFO. So if we are using FIFO, remember FIFO, that's first in, first out. So to calculate the value of inventory, the assumption is the units that we bought first are the ones that we sold first as well. So we are supposed to first of all, let's use that approach that we did in class. So we start with our purchases. So let's have our dates, in fact. So we have the dates of purchases. Then besides the dates of purchases, we need to know the price. Besides the price, we need to know the quantity. So the first date of purchases, the date, you can start with the date for opening inventory. Okay, we can start with the date for opening inventory. So 1 August, we had 48 units at 540. So 48 units, it means 48 units, that's our quantity. The date is 1 August. And the price, we are told in total, but we want the price per unit. So what's 540 divided by 48? 540 divided by 48. 1125. So it means we bought at 1125. Then the next date after this one, when did we make purchases? So the next date for purchases is 12 August. And the next one is 23 August. So we have 12 August and 23 August. Okay, so 12 August. And the next one is 23 August. So let's then move to the quantities that we bought on these days. So how much did we, in terms of the quantity, 12 August, we bought 50 and 80, 1150 and 1140. Okay, so we have 1150 and we have 1140. What were the quantities, by the way? Tatvanaba, it was what? Is it 50 and 80? 50, then we have 80. Then the next thing, we are now putting the dates of the sales. So we've arranged the purchases. This is the first purchase we made, followed by this one, followed by that one. So now the sales, what is the date for the sales? What is the date for the sales? Sorry, let me go back to. So for the sales, yes, 25 August, and we sold 90 units. So we sold 90 units. So for the 90 units that we sold, just a moment. So for the 90 units that we sold, we start by deducting these units from, we start by deducting from the goods we bought first. So for the 90 units, we are going to first of all deduct from the stock that we bought on 1 August. So for the stock that we bought on 1 August, we bought 48 units, but these are not enough. So we sold 90 units. It means we're going to first of all clear this batch. In this batch, there are 48 units, but we need 90. So after clearing the 48, how many units are left to make it 90? 42. So then clear the 42. So this means that for this batch, we no longer have any units. Then for this particular batch, we are remaining with 8 units. So the value of our inventory then becomes, so we have 8 units that are valued at, we have 8 units that are valued each at 1150. So that's 8 times 1150. Then we also have 80 units that are valued at 1140. So overall, the value of our inventory is 1004. Do we have that on our answers? So that is B. So that's how we calculate our closing inventory using FIFO. So if you are using FIFO, the assumption is the goods that came in first are those that you're going to sell first. Then if it is maybe AVCO, we are saying we can't tell which goods come in first. So we have to use the average. So now let's move on to the next question. Fourth company has a year ending 31 December 20X1. Which of the following are not adjusting events? So IAS 10 tells us events that are regarded as being adjusting and non-adjusting events. So what did we say adjusting events are? What are adjusting events? What are adjusting events? So if you're looking at adjusting events, we are saying these are events after the reporting period, but that are showing that they existed before the accounting year. So these are events that show conditions that they existed before the year end. Of course, we've not yet incorporated these events into our financial statements. So we prepared the financial statements without being aware of these events. So these events came to light after the accounts had been prepared. So let's think of a case maybe where we discover that there was fraud taking place. Money was being stolen. So we had recorded the year, the balance, the year-end balance was including amounts which were stolen already, which were not existing in company. So IAS 10 then says, we have recognized this event after the year end, but it's showing that it was actually existing when the year ended. So the balance you had reported for the year end is a wrong balance. You need to adjust that balance. So IAS 10 says we have adjusting events and we have non-adjusting events. So we have adjusting and non-adjusting events. So a certain event can either fall under the criteria of being an adjusting event or it can be a non-adjusting event. What these events have in common, they are all being found after the year end. So if the year end is 31 December, it means these events are occurring after 31 December. If it's 31 December 2014, then the adjusting events, we get to know of them after that date. Normally, it's before the accounts have been signed by the auditors. So what happens? The accounts are prepared Then after the end, we hand them over to the auditors to verify. Then after the auditors have verified the accounts, they are then handed over to the shareholders. So adjusting events, these are identified after the accounts have been prepared, but before they have been handed over to the shareholders. So these are identified after the year end, but before the accounts have been signed by the auditors. So the auditors have not signed the accounts yet to confirm. The auditors have not signed the accounts yet to confirm that everything is true and fair. Then we come across these events. So we either adjust the financial statements, or we can say this event is a non-adjusting event. So adjusting events, the common adjusting events that we are likely to face in questions, we have a debtor who suddenly becomes insolvent. Debtor who becomes insolvent after the year end. So this debtor became insolvent after the end. We can look at a case where we discover of error and fraud. Discovery of error and fraud. If we discover that there was an error or there was fraud, that's again an adjusting event. Then if we discover maybe that the inventory was not recorded at law of cost. It's normally discovered if you sell at a price lower than cost. Inventory is sold at a price lower than the amount recorded in the accounts. So we say inventory was supposed to be valued at the law of cost and net realizable value. So if we sell inventory at $20, but in the books last year, we had recorded this inventory near $30, it means you had overstated, because the standard was says that you're supposed to value at the law of the cost and what we can recover, which is the net realizable value. So it means you had valued at a price which is above. So these are some of the conditions that can call for an adjustment in the financial statements. Then the non-adjusting events. Non-adjusting events, the common non-adjusting events that they will bring are issues to do with disasters after the financial year. So as you can see, there was a fire after the financial year. That is not an adjusting event after the year end. So we're told maybe the warehouse got burnt after the year end. That one is not an adjusting event. So disasters after the year end, or generally other transactions occurring. Transactions occurring after the year end. If we are to maybe sell, we make sales after the end, it's not adjusting event. So for it to be, I think the events that are key to memorize are the adjusting ones. Because once an event fails to become an adjusting event, it has to fall under the criteria of non-adjusting events. But in most questions, they bring the events such as a fire or disaster after the end as a way to confuse you, so that maybe you think, since this is a major disaster, it must be adjusted for. So for non-adjusting events with a significant impact, for non-adjusting events, if it's a non-adjusting event, but if it's a major non-adjusting event, such as maybe the destruction of the whole building, we don't adjust, but we disclose. For non-adjusting events with major impact on our financial statements. So for non-adjusting events with major impact in our financial statement, we don't disclose, so we disclose. We don't adjust, but we disclose. We don't adjust, but we disclose. Now with that in mind, let's go and answer the question. So what do you think is the correct answer? So yes, fire, which is a disaster occurring after the year end, because our year end is 31 December 20x1, and the fire occurred 6 January 20x2. Then number 4, again, is after the year end, and another issue is dividend. So the dividends declared or paid are not adjusting. As long as they have been paid after the year end, they are not adjusting events. So unless if they said dividends paid were not recorded. But as long as they are being paid and declared after the year end, then they are not adjusting events. So 3 and 4. Let's move on to the next question. Number 27. A business sublets surplus office space. So if you're subletting, it means you're renting out. So in the year ended 30 June 20x5, cash received from the tenants was 83,700. Rent in arrears and in advance at the beginning and end of the accounting period were as follows. So we are the landlord. We are the ones that are letting out the property. What figure for rental income should be included in the statement of profit or loss? So in this particular case, we are looking at ourselves as, in this particular case, we are looking at ourselves as the landlord. So we want to calculate how much is the rent from the view of the landlord. So in this case, the rent account that we prepare, so in this case, the rent account that we prepare is not the rent expense, but is the rent income. Because to us, it's income. So we are going to prepare the rent receivable account. So for rent received, our prepayments are on the credit. They are on the credit side. Prepaid BD, then if we have owing BD, then if we receive a payment, it could be bank or cash, then we have our owing CD. Then this side, we have, so remember, owing can be followed by owing. So if owing bid is on the debit, it means this side you're going to have prepaid CD. Then the profit and loss, which is our balancing figure. So let's go and slot in the amounts that we are given. So for the rent receivable, so this one, if we receive a rent, it's not an expense. That's why we are putting prepaid BD on the credit side. Why are we putting prepaid BD on the credit side? Remember when we did the prepayments, accruals and prepayments, we said that if rent is received, if rent received is prepaid, it's actually a liability. So if rent received is prepaid, it's more of a liability to us because we have received the money that we have not yet let out the property for use. So it means we are the ones that have the obligation. So if rent prepaid, if rent received is prepaid, we put on the credit. So how much is the rent received prepaid? Do we have that in our question? How much is it? 2,400. So you check the dates. So 2004, these are the BDs. So advance 2.4, then 3.8. So 2.4, then this side 3.8. Then besides the owing BD, how much did we receive that year? We credit this because the double entry is that we debit the bank. So how much are we going to put as the bank or cash, the amount we receive? 83,700, yes. So 83,700. Then from there, we move on to our closing balances. So we have 4.7 for accruals and 3,000 for prepayments. Let's work out the, how much is it? 84. 84,000. Profit and loss. Okay, so let's move on. So from there, let's move to the next question. We have 84,000, yes, that's 8. On 1 January 20X1, Jean commenced development of a new computer game console. Development costs were 1 million per month. So remember, we have research costs and development costs. So we are told development costs were 1 million per month. On 1 October 20X1, Jean Company firmly believes that it has sufficient knowledge and resources to finish the product. Market research demonstrates that there will be high demand for the new console. How much can be capitalized in the year ended 31 December 20X1? So remember, let's go back to just a quick recap. We said that for research and development costs, research and development costs. The research costs, these are the costs that we pay to undertake an investigation. If it's research costs, these are the costs associated with undertaking an investigation. So these are the costs associated with undertaking a planned investigation. So we first of all do our research. Then after the research comes development. We research, we get information. After researching and getting information, We then apply that information to get a product, to get a service, to get a method. So when you're now applying the research findings, the process is now called development. So these are now the costs. These are the costs associated with applying the research findings. So you need to be able to separate, this is research cost, this one is development cost. So research, you are undertaking an investigation. Once you are done, you start applying your research findings. That process of now applying is now development. So the treatment is research costs are expenses. Research costs are treated as expenses. So research costs, they are treated as expenses, whereas development costs are capitalized upon meeting a criteria, are capitalized upon meeting the capitalization criteria. So you don't just capitalize the development costs. They must meet the capitalization criteria. If they fail to meet the capitalization criteria, we treat them as expenses as well. So when do we start capitalizing development costs? So the costs that are associated with the development, we start treating them as non-current assets when capitalizing is treating them as non-current assets. So we capitalize them if they meet we capitalize them if they meet the pirate criteria. So we capitalize them if they meet the pirate criteria. So probable of yielding benefits. We must be able to, we must have an intention to complete. We must have the cost that we have met. We must be have a reliable estimate of the cost we have incurred, reliable estimate of cost. We must be having resources to complete. We must, the project, it must have technical feasibility. Then the E is almost the same as the first one. So we are saying we capitalize if there are benefits we are expecting from this development. After we have completed, is it capable of yielding us benefit? After we, do we have the intention to complete? So we can start the development, but do we have an intention to complete? From the time it's now showing that we have an intention to complete, we now have the resources and the costs we have incurred can be measured. That's when we can now capitalize the development costs. So looking at the question in concern, let's check when should we start capitalizing the development costs. So for the question in concern, 1 January, that's when we started development. But 1 October, that's when we had sufficient knowledge and resources. So before you have the resources, availability of resources, before you have resources, you don't capitalize. You treat the development costs as expenses. But from 1 October, now we had the resources. So from that time, we can now capitalize the development costs. So it means you're going to capitalize for October, November, December. That's October, November, December. So we are capitalizing for how many months? 3 months. And the cost, it was 1 million per month. So it means the amount you're going to capitalize then becomes what? 3 million. So we're going to say the 1 million times the 3 months from October. Why the basis for the 3 months is because the resources were made available in October. So this is now when we had the resources to complete. Then, now let's move on. From there, let's move to the next. Based upon the IASB conceptual framework, which of the following provide the most appropriate definition of an asset? So remember, an asset, this is a resource that we have in the business as a result of what we did in the past, from which we're expecting to get benefits from. So the question is saying the most appropriate. So it's not just about the definition, but the most appropriate. So which one is it? C, a present economic resource controlled by the entity as a result of the past. So A is wrong. They are not telling us about control there. For it to be an asset, it must be in control of the business. Of course, it's because of what we did in the past, but an asset is what you have control over. Not what you have, but what you control. So the resource you are able to control and use to generate economic benefits, that's an asset. An asset is an obligation? No. An asset is a present economic resource controlled by the entity as a result of past events. So for it to be our asset, it must be something we are able to control. Remember the key definitions: we have an asset, we have liability, but from the conceptual framework, we have an asset, we have a liability, we have an expense, we have income, we have equity. Those definitions, you should know them. They can ask you those. Now let's move on to the next question. Each company is preparing its statement of cash flow for the year ended 30 April 2024. During the year, it disposed of a vehicle with a carrying amount of 5. At the date of disposal, proceeds of cash of 3,000. The vehicle had been purchased at a cost of 9,000. What amount should be disclosed within the investing activities classification of the statement of cash flow in respect of the vehicle disposal? So remember, we are looking at what is the cash implication. So we look at the transaction which has an impact on the cash flow and under investing activities. So if we disposed of a vehicle, before we look at the answers, if you sell a vehicle, what is going to affect your cash flow? Investing activities, if we sell a vehicle, where is it going to have an effect? Which amount, is going to have an effect? More investing activities. It's the what? Okay, so Nruguti, like which amount, but not think it's a vehicle. The EP, yeah, amount you know in the investing activity cash flow. Which amount? Is it the disposal amount, the carrying amount, the sale proceed, the what goes into the investing activities? Is the sale proceed. And so investing activities is the sale proceed. It's not the carrying amount. It's not the purchase price of the vehicle. And so it means from this entry, what amount should be disclosed within the investing activities? Investing activities, we are supposed to put a cash because we have sold, so it's cash inflow of 3,000 only. Disposal, loss on disposal is an operating, not investing activity. So that one C is wrong. A loss on disposal, that one is again wrong because loss on disposal is an operating activity. No items, that's wrong again. So B is the correct answer. With regard to a business registered to account for sales tax, which of the following statements is true? I think I have mentioned this. I have mentioned this when we started. So regarding sales tax, how are we supposed to account for the sales tax? Yes, revenue should be recorded net of sales tax. We don't include sales tax in revenue calculation. So 3 is correct. What about 1? Because we have 3 and 1. 1 is saying sales tax is always a liability in the statement of we don't record it. So corporate tax, that's a liability. But so item 1 is referring to corporate tax. But sales tax, we don't record it in our books. So that's D for. Then number 32, when completing his final accounts, Dale had overstated year-end accruals. So he had overstated year-end accruals. How are Dale's net profit and capital affected by the correction of the error? So the assumption here, if they just say accrual, we are assuming it's an accrual for an expense. Of course, someone can argue and say, what if it is an accrual for an income? But the assumption is if they don't mention, then we treat that, we assume that's an expense. So accrued expense, if it has been overstated, it means we had, because accruals, they increase expenses. So it means we had deducted a higher amount for expenses. So by correcting this, let's go and have a demonstration there. So let's assume you have a gross profit. So you have your gross profit of 40, then you have your expenses. So the expenses figure, let's assume the expenses figure in the trial balance is 20 plus an accrual, because we add accrual. We added accrual of 10, so it means this would give us an expense of 30. So then we are told, no, the accrual was overstated. It was actually supposed to be, instead of 10, it was supposed to be $1. So what would be the effect if we are to reduce the accrual? If we reduce the accrual, it reduces the expense, thereby increasing the profit. So on the side of the profit, it increases profit. On the side of the profit, it increases the profit. So for profit, it increases. Then on the assets, if it's accrual, net assets, if we're talking about net assets, it's the current assets, the total assets minus current liabilities. So that's net assets. So it means if we adjust on the net assets, this is going to reduce our current liabilities. So the net assets will also increase because it means the current liabilities will be smaller. So it means if we were subtracting, because the net assets is, we are saying the total assets minus the current liabilities. So in this particular case, if we reduce, because if we correct the error, it means we are going to reduce the liability. So by reducing the liabilities, it means the net assets figure will be higher. Not just current liabilities, sorry. Net assets is the minus liabilities. So the net assets is equal to equity. So it's going to have an impact on, it is going to increase our net assets. Now let's move on. In the prior financial year, Picabo had a gross profit margin of 9%. In the current year, in the current financial year, the gross profit margin has increased to 16%. Which of the following might explain the movement in gross profit margin? Which may explain the movement in gross profit margin? So the gross profit margin has actually improved from 9% to 16%. Why do I think we talked about this one before? So what could cause that movement? What could cause the increase in the margin from 9 to 16? Yes, is the change in the sales mix ratio. So the sales mix ratio is the ratio at which we were selling our product. So if we were selling 10 units of A for every 3 units of B, so the ratio in which we are selling our products, that's the sales mix ratio. Changing the sales mix ratio can actually result in an improvement in the gross profit margin. If now you are selling a product that is giving you more profit, so we were selling maybe 2 units for every 5. Now the 2 units that we are now selling, so let's go to our Excel. So we have 2 products that we had, product A and product B. So these products were giving us a contribution These products were giving us a contribution as follows. The contribution or the profit. So this one, it was giving us a profit of $4 per unit. Then this one giving us a profit of $6 per unit. Then the ratio, the sales mix ratio. Sales mix ratio, let's say we were selling 3:1. So it means 3:1, it means whenever you sell, you are selling 4 units of A and, 3 units of A and 1 unit of B. So in terms of the total contribution or profit you would make, that would be 4 times. So we're assuming the company is maintaining this sales mix. So 4 times 3, that's 12. 6 times 1, that's 6. So it means you are making a total profit of 12 plus 6. That's a total profit of 18. If you change the sales mix ratio, it means maybe now you are selling 3 for every 2. Or you are now selling 1 for every 3. So changing the sales mix ratio can result in you making a higher profit or actually making a lower profit, depending on the new mix ratio. So let's move on. B company has a draft profit after tax for the year of 100,000. BIP company has a share capital of 50,000 consisting of 50 cents ordinary shares. A dividend was paid during the year of 30 cents per share. What will be the profit after tax after accounting for these transactions? So the profit after tax, what would be the profit after tax? So remember that if a dividend is being paid, the dividend is paid out of retained profit and not out of the profit for the year. So the dividend is not going to affect the profit for the year. However, it will affect the retained fee profit. So in this case, they are asking the effect of the dividend, whether proposed or paid. None of the two have an effect on the current year profit after tax, but they tend to reduce our retained profit. So for number 34, what would be the profit after tax? It will remain 100,000. So the profit will not be affected. Then let's move on to number 35. Which of the following statements is not true regarding subsidiaries and associates? When you are accounting for subsidiaries and associates, so remember, a subsidiary, this is where we have control. And an associate, we have significant influence, but we have no control. So a subsidiary, we have control, but an associate, we have a significant interest, but not controlling interest. So the question then says, which is true regarding the accounting treatment? So when we buy or invest in a subsidiary, we calculate goodwill. Then if we invest in an associate, we don't calculate goodwill. If you make an investment in an associate, there is no need for goodwill calculation. So that's number one. Do we have an answer like that? Goodwill is not recognized when you invest. Yes, that's true. Then goodwill is not calculated when we, B is wrong. Then non-controlling interests are not recognized when we account for an investment in associate. Non-controlling interests are not recognized when accounting for, or we just want which one is not true. Which one is not true? So the one which is not true is B. So B is not true. Okay, so